A very warm welcome to all of you. It truly gives me immense pleasure to see so many of you are here for this special session on integrated business solutions organized by Board of Studies Academic. Thank you for taking the time to join us today. As you know, the integrated business solutions paper is one of the most unique and dynamic paper in your curriculum. It is not just a paper filled with theory or calculations. Instead, it makes you to think holistically, like a business leader. It blends concepts from financial management, strategic decision making, regulatory frameworks, and even operational challenges. In our earlier sessions, we discussed various companies and sectors like the airlines industry, FMCG companies, the tea sector. We explored how real world businesses use models like balanced scorecard, ROI, RI, EVA, how strategic models tools come into play, and how financial and non financial metrics are used in performance evaluation. Today's session is slightly different and quite interesting. We will be focusing on disruption. In this session, we will focus on disruption. Disruption means when a new idea, technology, or business model changes the way things have traditionally been done and forces others to either adapt or lose relevance. A perfect example of this is cyber cabs. It is our first case study. This cab model changed the entire taxi industry. Earlier, if someone needs the cab, they had to call a local taxi service or local taxi driver or hail one on the street. It was not always reliable. Sometimes cabs would overcharge, sometimes they won't show up. But then came Sabre with a simple mobile app. Suddenly, users could book a cab with few clicks, track the ride in real time, pay digitally, see fares estimates upfront. This gave customers a more convenient, transparent, and faster experience. Sabre didn't just improve the taxi industry, it redefined it. Please note word it redefined the taxi industry by use of technology. It created disruption. This idea of disruption is not limited to cabs only. Think about how the entertainment industry changed. Earlier, people rented cassettes from physical stores. Then came streaming services. These platforms allowed people to watch shows and movies from their homes on demand anytime. They offered suggestions based on user preferences and even started making their own content. The result many DVD cassettes rental store simply closed down, clearly vanished. But here's something important to understand. Disruptive decisions are not only about innovation, they involve serious thinking in areas like finance. Where will the money come from? Risk management. What if the new idea fails? Regulation and taxation. Are there legal or tax challenges? Corporate governance. Are decisions being taken ethically and responsibly? This is where IBS becomes so valuable. When you work on these case studies, You are not solving isolated problems. You are learning to think like a CEO, someone who must balance strategy, finance, operations, and governance every single day. Let me repeat something I have said before. The IBS paper is not just about marks, it is about mindset. It builds your ability to connect the dots, to integrate knowledge from different subjects, and to come up with well defined solutions. That therefore, this paper is very challenging and rewarding. To guide us today's cases, we are honored to have CA TV Bala Subramanian sir. He is seasoned management consultant with years of experience in project feasibility studies, merger and acquisitions, internal audits, business strategic business advisory. He has helped so many businesses in decision making. Today he will talk about two very interesting case studies. First is Sabre Cabs. As I shared earlier, Sabre is a tech company. It is app-based platform, connects passengers and drivers. In real world, it doesn't stop here. It also offers food delivery, freight services, and operates in 85 countries. It is not a company that disrupted multiple industries through digital innovation. In the case study, we will delve into strategic, operational, and financial decisions. Second study is Magic Blend. This is a homegrown company based in South India. It makes ready-to-eat foods, instant mixes, snacks, and spices blends. The company was doing well regionally for many years, but recently struggling with rising competition, falling profit margins, and inefficient operations. This case gives us chance to understand how to reposition a traditional business in a competitive market and using a strategic lens. These two cases are very different, but both highlights the importance of making the right business decisions at right time. All case materials have already been uploaded on the students portal. I encourage you to read them carefully and participate actively and ask questions wherever you feel stuck. During the session, feel free to speak English or Hindi, whatever you are comfortable with. You can raise your hand to speak or type your queries in the chat box. Let us make session very interactive and engaging. Also, we have set aside last 15 minutes of today's session to take up your general queries, those not directly related to case content. So please keep those ready too. With that, let us begin with the interesting case studies. Sir, over to you.
Sorry, am I audible now? Thank you
Yes,
all.
sir. Yes, sir.
Yeah, good. Good evening to everyone. I'll first share the screen and then we can straight away get on to it. Yeah. Yeah, hope the screen is also visible. So, as it was explained, the first case study is going to be about disruption in the market. And in many fields, we have already seen it actually happening. So, this is one such interesting case study which we are going to look at. Nearly every field, we are seeing that disruption is becoming the name of the game. You have companies which do not own a single room anywhere has become one of the largest hotel competitor today or stay competitor. Similar to that, in the cab business, companies which do not own any cars are becoming the driving the cab business. Like he was mentioning, even in the video, etc. The many of the old generation business have been replaced by new models. So every single phase you are seeing that there is a lot of change which is happening and in a disruptive manner. These are having far-reaching implications. So let's look at this specific case study on cabs, what it exactly happened and how it is moving forward. So just to give a background about this company, it was founded in 2008 by Ikshit Botra. He's the CTO, as you can see, a Chief Technology Officer. So look at it. The founder is basically an IT tech guy. So that is where it is coming from, but it is dealing in passenger transport. See the kind of change which is coming. And Saurabh Jain as the CEO. They started the company in 2008. It was headquartered in Pune with operations in over 85 cities with 2 lakh cars. Now, most of these cars are not owned by them. Actually, 2 lakh cars are flying using this company's facility, but they are not owned by the company. The company never owned 2 lakh cars, right? So, what kind of services they were providing? They were providing cab rides and then extended to auto rickshaws since 2012. Then they were also planning luxury rides, luxury limos being available for the common public, but that is what was in the anvil. That's how the company has been growing. From a key statistics perspective, by 2022, it was really controlling 55% market share. See the kind of growth they have had and the kind of control they have had on the market. 55% market share. And by 2023, they were valued at 6.5 billion. Significant valuation also. The company has gone to a stratosphere. So, what was its business model and the disruptive strategies which were there? First and foremost, I'm not going in any specific order or anything. Dynamic pricing. So they introduced this concept. Earlier, what was there? Every auto rickshaw or a taxi was supposed to be metered. You are supposed to pay by the meter. Then, if you use cab services, they had fixed plans. If it is 4 hours and 40 kilometers, so much, and then for every additional kilometer, so much, for every additional hour, so much, like that. Now, these people brought in the idea of dynamic pricing, surge pricing during peak demand. So when the demand is high, the prices go up. When the demand is low, the prices go down. So what happens in such a scenario? It brings a different perspective in the market. There are people who would try to move their travel to a non-demand, non-peak time because they can afford to do it. They are going on a private trip, etc. They could afford to do it. At the same time, those who are on business and who needed to go at a given time wouldn't mind the extra cost to do that travel at that point of time. So basically bringing in market forces into areas where it was hitherto unheard. It brought in a mobile app based hailing with real time tracking. So, first and foremost, you don't have to go and search for a cab or an auto rickshaw for that matter. In fact, there are other companies which were even doing two wheelers. You had it in your app, in your mobile phone. You just had to call and they came to you. Instead of you going and searching for a vehicle, the vehicle came to where you were. And all the time, you were able to see what is the status of your booking, what is the status of its arrival, whether it is en route, whether it is looking like it will come in time, what time you will be able to reach, estimate, all that was being available. So significant amount of change by bringing in a mobile app. Then they also brought in cashless payments. So more move towards digital wallets, cabin money. Of course, there are also many UPIs now available, which are significantly there. But these are the three significant disruptive points which they brought in the business model. So this changed the way things were working all these years versus what happened. So, what was the impact of these significant changes which they brought in? It reduces wait times. It brought in transparent pricing. So you were able to see and then decide whether to book at that price or not, etc. And you don't have to haggle. But it also had some negative impacts. There were a lot of opposition from traditional taxi unions, etc. But like it always happens, change is a constant. And change does not stop for anybody. So change is something which will roll on, and those who are able to go with the flow do well, those who are not able to fall by the side. So many of the old yellow and black cabs started disappearing because there was a significant change in the way things were operated. The business also looked at customer segments in a different way. They were looking at non-car owners to have an affordable sharing ride. So they pool instead of having to always pay up huge prices. This enabled the cab to be reused significantly, and it provided a better pricing for the users. It also focused on the corporate commuters who were mostly younger generation to go to the office, come back, or in between offices, etc. So there was a significant amount of change which was being brought in by these uh, segments. Then there were also the premium users who looked for luxury rides in metro cities, which is limited, but there is some play for that separately available. So, what was the value proposition they were bringing to the table? What was the value proposition which was being brought to table? The For the passengers, it was real-time tracking first and foremost. From the time you start booking for a vehicle till the time you are dropped off, every point is tracked. Right? You are completely aware of what's happening. There was also upfront pricing. You knew the prices before you booked it. And when I say real time tracking, even the tracking is something which you can share with somebody. So you could have somebody else also know where you are. It also provided for choice of rides. You could choose an auto rickshaw, you could choose a micro vehicle, you could choose a prime cars. You had multiple choices there. Then, because of the systemic nature of engaging onto the platform, etc., there were built-in driver background checks. So there was much more safety perception in this whole activity. And there was also 24 by 7 support. This was open throughout the day. It's not that it is working only like a travel agency. It does not work during fixed hours and then you don't have somebody. A 24 by 7. For the drivers, it again brought in a significant change. They could have flexible shifts and locations. They could choose to put their car on. They could choose to switch off and move forward without being engaged at that point of time. So this was one big benefit which they had, and that is very, very critical for them because they could decide to use to their convenience. Then this also brought about the possibility of vehicle loans being organized through this platform or through this association. with the entity. So they could get vehicle loans or a leasing model, which ensured that there was also protection, because the vehicle loan or the leasing model would also have some structure to ensure that there is some deduction of payments and payments towards the loans. So there was protection for the driver as well as for the lenders. So better pricing, better availability of loans, better availability of leasing, all that was possible. Otherwise, many of these drivers may not easily get a loan. That is another challenge which would be there in the traditional models. So typically what used to happen in the past was that there used to be people who used to own the cars and charge on a daily basis to these drivers for using the cars and running it. So they were getting lesser remuneration in the process. So this model brought in the possibility of taking own loans or getting cars on lease to themselves directly, so they could improve their earnings also. It also led to more training for them on safety and customer service. So it improved the kind of values they were bringing to the table overall and the experience which was being given to the customer ultimately. So all this is fine. This is what is happening in the cars and the passengers. What is happening? How does the company make money out of it? It had a very good revenue model also. It's not that it was devoid of a revenue model. It had a revenue model where it used to get somewhere between 15 to 30% as commission per ride. So there was commission income which was coming. Then the surge pricing used to significantly go to the benefit of the company. Then any cancellation fees used to go to the benefit of the company. And in addition to all this, there were also promos which were being run on the app. So there could be brand advertisements on the app, etc., which generated revenue for the company. So there was an opportunity here to have a good revenue model on top of a disruptive business model, which was making sense in a today's digitalized environment. However, all this is not simple. All this is not simple. Initially, there were a lot of challenges. The company had to face a lot of challenges with compliance with Motor Vehicle Act, with GST, etc., because there were a lot of gray areas which were not considered in the past. So motor vehicles had a lot of restrictions which were placed in it. So how to deal with it, how these would come in, etc., made a big difference. GST similarly, on what will GST be applicable if there is a certain portion which was going to the customer, or sorry, the driver. Now, if you hail an auto or a taxi on the road and pay for it, you don't pay GST on it. But the moment you have to do it through this agency, this platform, Cabber Cabs, then the question comes whether GST is applicable or not. And that's a significant expenditure on top of it. So all these had to be challenges, had to be met, and they had to be addressed over a period. This is on the compliance side. At the same time, there were also resistance. There was a lot of resistance to this change from taxi unions, etc. So, in fact, one of the challenges which they had faced was that some of these auto unions and taxi unions said, look, there is a law about how charges should be levied by such public transport vehicles like taxi and auto, which says clearly so much is the minimum charge and per kilometer so much, etc. So anything beyond that, then they are in violation. So these are all various grounds which came up. So there were a lot of back and forth which was happening, and a lot of these challenges had to be met to grow to where they have come. So nothing is devoid of, or like it was mentioned, everything has multiple angles which needs to be considered. So it's not just about doing some business, one type of business or the other. It's about bringing multiple angles into focus and addressing all of them. The company was also looking at two major future plans. One is to bring in luxury ride, right? Luxury limos being available for use. So this is one big thing they were looking at. The second thing they were looking at is to increase the number of directors from 7 to 16. Now this company has become very big. As you saw, 6.5 billion valuation. So they wanted to really professionalize and broad base their board to ensure that they have all the governance requirements and take it forward further. So they wanted to increase the directors from 7 to 16. So have a larger board. These are two key things which they were looking to do going into future. Along with that board, they were also thinking of a strategic leadership restructuring, right? Because they were expanding into multiple segments. It requires strong governance and oversight. It also requires a lot of specialized knowledge and domain specific expertise. So you needed more leadership roles to be brought in to ensure that the various requirements are being addressed. And in that context, the existing board was only about 7 directors and they were looking to make it into 60. They were looking to get in qualified and experienced professionals because the company was now having much more strategic vision to go forward. So they wanted more qualified and experienced professionals to come into the board, which would lead towards increasing their capability to manage diverse operations and the kind of future growth they were looking at. High growth company. So there is a need for a lot of thought and nimbleness. So to bring all that, they were looking to get much more experienced heads to give them better direction. So that is what they were looking at this point of time. So as I was mentioning, for the drivers, it made a huge impact in a different way. It brought in financial inclusion. So earlier, what used to happen, the drivers used to lend or get the vehicle on a daily rental basis, and the daily rentals were hefty. And from after that, they had to earn something out of it, and that too, they were dependent only on people who will hail. If you are in the right locality at the right time, you will have somebody asking for your vehicle and you will get revenue, right? So it became a big thing. And a large portion of their earnings were going towards paying these rentals on the vehicle on a daily basis. With this kind of a operation being brought in by cabs, it enabled NBFCs to look at this model as an additional support for them to ensure that there will be timely recovery of the loans. See, what is the biggest concern finance companies have in lending? How will I recover? If I give it to individuals, individual taxi drivers, how will I be able to recover that loans without losing much money? That would be their concern. So by having a huge portion of the collections being routed through a corporate entity into the hands of the drivers, there was a possibility that they could have a tripartite agreement, etc., to ensure that some amount is collected and paid to them, though not binding on the company, maybe, but at least as a channel, and they also knew the kind of earnings which were coming from that. So both these put the possibility of vehicle loans being given to the drivers significantly. Not only as loans, but many of the entities were interested in leasing cars to these people on a long-term basis. With all this came not only the availability of finance, but also at a better interest rate. Because now they knew that there is a mechanism which gives them good data as to the earnings of the driver, etc., and maybe a possible source for collections from such revenue sources. They were willing to reduce the risk and accordingly the interest rates. So this benefited the drivers significantly by bringing in financial inclusion and ownership. So as I was mentioning, vehicle leasing was also not only lending, but leasing also was a big win. There could be weekly deductions. Why this was possible? Primarily because the money is coming through the company and cabs could pay towards the leases before paying off the individual drivers. And they were able to similarly enter into good purchase arrangements with large dealers, right? So that was another big benefit they could get, or even from the OEMs. So lease agreements had normally they always have repossession rights. So this also gave the protection that in case somebody defaults and wantonly does not service, there is always the possibility of taking back the vehicle and somebody else taking it and moving forward. The vehicle registration in lessee's name was permitted under the Motor Vehicle Act with all this. So these were the big benefits which came from the lease programs also, which were there. There was a tax issue which cabs faced in this context. Because like I said, in a real world business, the issues which come are from multiple sources. So here was the case where there was a tax issue also which came about. Cabs claimed depreciation of 5 crores in 23-24 on the motor cars leased out to drivers. So the motor cars are leased out to drivers, but the depreciation was being claimed by cabs. So this was another thing which was coming up in this thing, and they had tax issues which came up. Finally, it got resolved to the benefit. We'll look at it as we move forward, right? So in the background of this, now we come to some specific questions where we can discuss, or any other questions which you have also we can discuss. Please do put in your answers in the chat box as we see the MCQs, so that we can also consider what each of you are putting up there. Which of the following statements accurately describe characteristics of a disruptive innovations of cabs? Cabber initially targeted niche markets, competitive performance versus traditional taxis, immediate market dominance, incumbents overlooked cabbers innovation, innovations improved over time. These are 5 things. What are the characteristics which are there, which are leaning towards disruptive innovations of cabber? The possible answers are A, 1, 2, and 4 of the above. B is 1, 3, and 5 of the above. C is 2, 4, and 5 of the above. D is 1, 3, and 4 of the above. Any answers from you all? Please put it in the chat box so we can look at it. Somebody has said A, one more A. Someone has said D. Any other thoughts? So if you look at it, the option A is the right answer, as some of you have pointed out. So what were the things which were pointing to that A being the right answer? Let's look at it. Niche markets, yes, it started in Chennai and then expanded gradually. So niche market was one very clear this thing. The second one is competitive performance, that is item 2, right? So it had a competitive performance by real-time tracking, surge pricing, etc., which were not present in traditional taxi model. So that was the second important thing. It did not get immediate market dominance. So that is not the innovation, right? Market dominance came over a period, and that was a result. That is not the disruptive innovation per se. But four, incumbents overlooked Cabot's innovation. So they did not look and understood in time the innovations which Cabot had brought in. So the traditional taxis had ignored the app-based model, which you can see today that many of the traditional taxis have died down. There are only a few places where you find the traditional taxi services running. In fact, so much so, even the kind of hourly packages which are offered by travel agents and things like that have been largely replaced with these kind of ride hailing software companies, right? They have also brought in packages. So literally they have stormed the market. In fact, you can see the newer models which are coming, newer businesses which are coming are also going on to similar kind of platform model, even though they may restrict it to a few services within that. But it has significantly changed the whole thing. In fact, so much so that this has brought in even one-way drop between cities, which was unthinkable in the past. So all that has been brought in by the innovations which were brought in significantly. So somebody has asked why four in this thing. Like I said, the incumbents, which are the existing traditional taxi operators, both individual taxi operators as well as travel agents and fleet operators, they overlooked the innovations which Caber was bringing in. Earlier, they all had only a telephone service. You can call and book a cab. But now nearly everybody is trying to upgrade or get out of the business and put it onto this one of the platforms. The second is on the GST issue. Let's look at the sample of this thing. The driver's fee is around 800. The booking charge is 200, right? Then there is a GST of 5%. Now the question is, who's to pay this GST, right? 1050 is the fare, is one option, where CGST is 25 and SGST is 25, and Caber is liable to pay this GST to the government, right? The second is 1010, where CGST and SGST are 5 each, and the passenger is liable to pay to the government. The third is 1120, 60 rupees of CGST and 60 rupees of SGST, where the driver is liable to pay the GST to the government. And 1096, which is for payable, 96 rupees of CGST and SGST together payable by the passenger, right? Now, somebody has said Caber is liable under section 9(5). Another has said A came. So the GST was one of the big things in these disputes which came up. right? So the question is that it added to cost, which was not there in a traditional taxi model, largely. If it was a fleet operator, it was there. Yes. But when you are doing a roadside hailing, it was not there. The moment it went into this, it became a GST issue. So the answer is A, as was pointed out by some of you very clearly. The answer is clearly A. The correct option is 1050, where 50 rupees is the GST, and that GST is to be paid by the cable cabs because they are the ones who are billing. And section 9.5, as rightly pointed out by one of you in the answers, very well done. Section 9.5 of the CGST, it says the e-commerce operator will have to pay. So these are new models. Nobody thought of this. 20 years back, if somebody had said who should pay for this, there would have been a huge discussion and debate and all that. Currently, GST brought in all this, saying, okay, this kind of a model, then we need to understand who is going to pay for this. Here, if you really see, 800 rupees is actually driver's fee, 200 rupees is the booking charge, and 5% thereon has to be paid. So one way used to take 800 rupees is not even my income. Where is the question of billing GST on that by me as cabs, right? And the driver will say at 800 rupees, I am never going to cross 20 lakhs. I am not GSTable. Where is the question of me charging GST? So that is when they brought out clarity. So, my dear friends, I again want to reiterate what was time and again been told that when you look at a business model and when you look at a complex business scenario, you have to look at it from multiple this thing, and there are actions which are required in multiple directions. So if there was lack of clarity on GST, now getting that clarity itself is one task which was there. So getting this e-commerce operator pays as a regulation in place itself is a very, very important step. Now, many of such things in the legal jurisdictions have been brought in by the actions taken from uh, the players in the market, right? Because they have come up with something new and they had to find a solution. They come up with multiple solutions and then get regulator also to look at it and take appropriate direction or appropriate action in the right direction. So all that is coming from such changes in multiple things. So this was specifically introduced. This does not apply only to cabs or this kind of a cabs kind of a business, but it applies in many scenarios today. You have quick commerce companies, you have e-commerce companies, so you have delivery agencies, you have suppliers who are on the net or on the app, so many things. So this has come to stay by doing in the right direction, covering all that kind of a new model businesses. The next question is about business model adaptation. So in the business model adaptation, the question is Cabber's premium rights. So as we were discussing, Cabber is considering a premium right? Aligns with which model? Experience model, subscription model, on-demand model, or a free model? Any thoughts on this? Someone has said C, someone has said CA, someone has said C on demand. So most of it has been C, right? The major thing is basically, yes, looking to a instant booking based on dynamic pricing and convenience to match the on-demand economy. So if you want something quick, pay for it. If you are willing to pay for it, then you get that kind of additional thing. So it's that it's that ability to sell at a higher price. The fourth MCQ question is about life cycle stage. So analyzing the facts from the above, determine which classification best describes Caber's current growth stage. Is it in a startup stage, scale up stage, unicorn stage, or it has become an incumbent? What are your views? Let's look at that. Any thoughts on that? Anyone with any thoughts? Someone has said unicorn. Okay, so let's look at the answer, right? Caber is a privately held company with a valuation of 6.5 billion, which meets the criteria for being classified as a unicorn. While it has already established its presence in the market, expanded its operations, and diversified its services, its valuation of 6.5 billion indicates that it has achieved significant growth and is valued at over 1 billion, thus meeting the criteria for 1 billion is the criteria for calling it as a unicorn. So it has reached that stage and it is still in a growing stage. So it's a unicorn which has come back. The next question is, like I said, you have to also think from multiple dimensions. So corporate governance. Which statement is correct regarding the number of directors in accordance with the provisions of the Companies Act? You remember we were discussing they wanted to increase from 7 to 16, right? The board size. So in that context, we need to understand what is the Companies Act requirement, so how do we meet that and how do we address that? So in that context, it is important for us to understand what is the requirement under Companies Act. So the first option is the increase in number of directors can be implemented by passing a general resolution in the general meeting. That is, the members in their meeting can pass a general resolution and increase the number of directors. The second is the company should pass a special resolution in a general meeting to increase the maximum number of directors. So the second one is also saying that there should be a general meeting, but it's not enough to get a general resolution, it has to be a special resolution. The third option is the company cannot increase the number of directors beyond 10. The fourth option is the company cannot increase the number of directors beyond 15. So let's see what options you have brought out. So 3 people have said B, right? Fourth person has also said B. So I think everybody is thinking B. So let's look at it. It has to be. right? So this is the important thing which I wanted to again re-emphasize. So when we are discussing about many things, you need to look at it from multiple dimensions. According to section 149(1) of the Companies Act, the maximum number of directors allowed without a special resolution is 15. So in the normal course, the board size can go up to 15. If it has to be increased beyond this limit, it requires resolution to be passed and a special resolution to be passed under 149(1) of the Companies Act, right? So this is the reason why there is a need for a special resolution in this case. Now let's look at some descriptive questions. Again, I would like you to put your thoughts on each of these. The first one is, how did Caber address customer pains and generate gains? Discuss strategies and social environmental benefits. So, A, how did it address customer pains and because of which generated gains? 2, what were the social and environmental benefits, right? So, let's look at some thoughts from you all and we can discuss them. Come on, guys, you can put in some thoughts. How did they address making cabs available at the convenience of the customer? Is one thought. Yes, right? Real time tracking, upfront pricing. Yeah. Multiple ride options. And the customer pains are difficulty in booking and safety issues. Checks on the drivers, 24/7 support. Right? These are some thoughts which have come. So let's look at the right. So value proposition was how you look at the pains and gains, right? So what were the gain creators? You have various ride options like micro, Pimes, hair, etc. Then you have loyalty programs which can be there. There are social and environmental impact due to reduced traffic via pooling, lower emissions, because the cabs are getting better utilized, right? Rather than going one way empty. So those are the benefits which were coming from that. Hassle-free booking, right? Somebody had pointed out, yes, very valid point. Driver checks again had been pointed out, real-time tracking was pointed out, upfront pricing was pointed out. There is no need for haggling because of that. Digital payments is another big benefit which was brought in, right? So these were the significant things which were addressed in this particular model. So the second one is draw Caber's business model canvas. You can talk about it instead of drawing up, right? I'll put out the this thing, business model, and you can put your thoughts on each of these, right? Each of these, so that we can discuss that. So this is broadly the business model canvas. Let's look at what are the various thoughts you have under each of these or under any of these. Some thoughts from you all? Okay, so let me discuss then, right? So first, let's look at the first bucket of key partners. So look at this kind of a business model. What kind of partnerships are required? There are technology providers, right? You need a lot of technology for running something like this. There are financial institutions because you are getting leasing, you are getting vehicle loans, right? Facilitated. So there is a lot of financial institution involvement. Insurance. Now, one of the things they offer is for a small amount, insurance on every trip or insurance for missed flight, etc. So there are tie-ups with insurance companies to do some insurance business also in this small amounts, but you know, in millions of transactions, these small amounts make a big this thing. Then all this requires a map, right? So the map API providers, they are another big partners. So see the kind of things which are coming, being brought together in this. A significantly different thing than what you would have thought of when you are talking about providing a taxi service in the city. I mean, the taxi service, look at it, taxis are not there yet. The first things are something else, right? Then payment processes, because you are offering digital payments. Local authorities, because you need to ensure that there is compliance with various requirements under the Motor Vehicle Act, etc., etc. Drivers who own cars or lease cars or take a vehicle on loan, etc., right? So drivers. Then staffing agency, where you are going to staff some part of it on a different business model, maybe on a simple salary model or on a salary plus incentive model, whatever it is. So look at this. We are talking about a transport business, and cars are not the important thing. The important things are something else first. Significant amount of partnerships with various other business providers. The key activities are communication with driver, customers, and partners, which is all significantly enabled by this app. So automatically it is going in text form, in updates. Then it also permits speaking where required, right? Then hiring drivers and handling their insurance and payouts through a secure medium. So if you are using drivers, you have to ensure insurance, etc. is there. And the payments are all being done in a very secure manner, because you don't want issues to come up that on there, because you are going to handle significant amount of money, right? Analyzing data to continuously rectify any shortcomings and keep continuous improvement. So there is so much of data which is being generated in the process of doing this business. So how you can analyze that data to improve your services? For instance, can I give pointers to drivers as to which location, which day, time of this thing is a good opportunity for them than hanging around somewhere else? So these are significant things which can come. Sales promotions to acquire new customers. Then platform development. The platform has to be continuously developed to ensure that you are improving more and more and providing more and more services, improving the way you are servicing, create better customer experiences, etc. The key resources used in all this is first and foremost the platform, IT platform on which the whole thing is running, which is the most important thing. Without that, this business is not there. This business is not so much about cars in the center. It's about the platform in the center. Then the pricing algorithm, as we were discussing, the pricing has to consider the time it takes, because time also varies depending on the time of the day and the traffic in the route. Time also varies. Obviously, the expectations of even the drivers are more if it is going to take more time. There is this opportunity of surge pricing to improve your earnings also. Like even in airlines, you see ticket fares are not fixed fares now. It used to be fixed fares, but nowadays it is all variable fares. The flexible fares depending on the demand supply situations. So you have to have a good pricing algorithm. Then you have to have the right brand, right? Right brand and staff. You need, for all this, you also need good brain to put things in the right direction. Continuing further, on the value proposition, first and foremost for the driver, it's a flexible learning opportunity. So the drivers are basically entrepreneurs. They are not employees. They are entrepreneurs with flexible earning opportunities. They can decide to work for 4 hours, they can decide to work for 12 hours, of course, subject to certain safety criteria, etc., being attached, right? Because you can't have the same driver running for 16 hours and then being alert to run the car. So you need to have some safety mechanisms built in, but subject to that, they have that flexible opportunity to run for 4 hours or 8 hours as they feel. Safety and security is other big value proposition for the user, because these are all controlled by the app and they are all centrally registered vehicles and drivers, etc. There is certain amount of dependency that the drivers have been verified. The drivers are traceable. Their own trips are tracked and trackable. That's a high level of safety and security feeling in the whole process. Convenient and easier transactions because you know the price upfront, you can pay by digital or cash, mostly digital, meaning then it becomes very easy, right? You get in, get out, happily go. There's also an opportunity to get an insight as to the fare and the duration of the ride upfront. So you know this is going to cost me $120 and it's going to take me 17 minutes to reach there. So it gives you that kind of information. Earlier, you never knew what it's going to be, the time it's going to take. And even when it was a metered taxi or a metered auto, you never knew upfront how much it is going to cost when you go there. The meter keeps running. You don't know whether it's going to cross 100, whether it's going to cross 250 till you reach the destination. See here, it gives you upfront information. Competitive pricing and diverse ride options. So it gave you competitive pricing because it's looking to catch the market, and it was also giving you options. These are upselling. Okay, boss, you want to use the normal car, you want to use a prime sedan, you want to use a super prime car. Yes, options are there. Then there were other complementary benefits which were coming because of this, like the insurance cover you can have, like the if you lose to catch the flight kind of insurance you could take, etc. Customer relationship, there was a review and rating mechanism, so the drivers also get some rating So over a period, you know which drivers have performed very well with the customer service. It helps you improve the service quality. It helps you weed out very poor quality drivers. It helps you to identify which drivers require training in certain areas to improve better. There is also a lot of social media engagement in this and a comprehensive 24 by 7 customer support. Now, these are the big benefits of this model. If you look at the segments, one side you have the passengers, one side you have the drivers, the other side the retailers who could be also interested. The channel was a single channel, Cabber app, no other channel, right? Because that's what is your USP into this whole thing. My app, you download my app and work on that. Cost structure, you had to consider the various things like legal and settlement cost, insurance cost, platform development and maintenance cost, which is a huge cost, customer support cost, salaries for various people, sales and marketing costs because you had initially done a significant amount of marketing to reach this kind of growth, data center and networking expenses, which again are a big important requirement because your whole thing runs on tons and tons of data. So it requires significant amount of IT infra requirements. Then R&D expenses, because you have to continuously keep doing something better. You have to continuously innovate. Otherwise, you will be left by the side. So these are the big ticket costs which had to be considered. And the revenue streams were from right transaction fees because the driver's portion is upfront decided, right? So that will go to the driver. Dynamic surge pricing fees, cancellation fees, and any Cabber app interfaces which can provide you some additional revenue like brand promotions which are run by others, advertisements, etc. So these are the things which are coming. There could be insurance which could pass on some benefit to you. All these kinds of added benefits which can come. Now, with that, we come to the third question and the last question for this session, right? Assessing officer rejected depreciation on leased vehicles. Please comment. So, any thoughts on this? So, we discussed during the case study also that the company was looking at leasing as a model and there were leased vehicles and the company had claimed 5 crores depreciation. Yes, somebody has said aloud. So let's look at the answer for this, right? And why. The key points are first and foremost ownership. Lease agreement grants Cabber repossession rights. So Cabber had the repossession right. Leasing is Cabber's business activity. So we were leasing it out. And there was also a legal precedent from a different business from the past. ICDS used to be a NBFC in those days versus CIT, where it clearly said lessor can claim depreciation. So ICDS was leasing out, right? So on this case law was the precedent which was available to say, okay, boss, just because I'm a cabs company doesn't mean that I cannot lease out. And when I do a lease out, I am eligible to claim depreciation. So ultimately, the AO's rejection was held as invalid in this case, and this is the background to it, and this is the case law, which is from a different era altogether, but on a similar subject. right? So with that, we are coming to the close of the first case study. If there are any specific questions on the first case study, we could take, otherwise we can take a break, 10-minute break. But before that, please tell me if you have, any of you have a questions, we can discuss now. So somebody has asked, may I know what is surge pricing? Now, surge pricing is basically pricing for the product based on the demand, right? So when the demand goes up, you increase the price. When the demand goes down, you reduce the price. So this is called surge pricing. So how do they apply in scenario like cable cabs? During the peak hours, morning 9 o'clock, when everybody is trying to rush to the office, there is a huge amount of pressure for finding a vehicle. So at that time, the prices automatically go up because the demand is more. And then by about 11 o'clock or so, the prices come down because the demand is less. Now, if you see this concept, it is not new. Yes, somebody has pointed out surge pricing is the dynamic pricing we have in trains too. Yes, they have introduced. For instance, this dynamic pricing in train, if you remember, was introduced only a few years back. Earlier, it used to be a fixed fare, that's all. You either got the ticket at the fixed fare or you didn't get the ticket, that's it. Now, depending on the demand, they have increased the prices. So, the same way airlines had also done. In fact, airlines did before the railways. So, airlines brought in these flexible prices where, based on the demand, they increase their prices. So, every business is trying to take on these kind of things to get benefit of the pricing based on the demand at that point of time. Simple thing, we all know that during certain festival times, certain specific things which are unique to that festival, the prices go up significantly. Like every time when there is a Ganesh Puja coming, you will have that, clay Ganesha's price going up significantly. The rest of the time, it might be available for probably 50% of the price or 25% of the price. Obviously, they price higher at that time because there is going to be demand. So this is called as the surge pricing. Any other questions? Anyone else having any questions? Okay. Otherwise, what we can do is we can take a 10-minute break. It's around 7:50 now. 8 o'clock we'll commence on the second topic. Thank you. So 8 o'clock we'll start the second session now. Till then, take a quick And I think we can start now. Can we go ahead? Yeah, good. Thank you. So I'm going to straight get into this second subject. The second subject we are looking at is a company called Magic Blend. Basically, they were looking at a revival of the company, right? So I will take through quickly because there are many slides in this. Of course, the subject matter is smaller, but the slides are more. So basically, to give you a background, Magic Blend was a South India-based mid-sized packaged food company. So they were making packaged food, specializing in ready-to-eat items like instant mixers, snacks, spice blends, etc. This is what they were making, right? Once upon a time, it was thriving because they had a robust distributor-led retail network covering a lot of tier 2 and 3 cities. But in the recent years, I've seen declining margins, rising competition, and operational inefficiencies. So primarily, they were smaller sub-regional players. So obviously, with many other bigger brands and names coming and trying to take over the retail, they were under threat. A financial due diligence was commissioned by a potential investor who was considering a controlling stake. The goal was to assess financial health, identify red flags, and chart out a turnaround strategy, right? So this was the objective of the investor who was looking at it. How to make it viable and profitable going forward. So the diagnostic review involved a desktop-based analysis of historical performance, on-site plant and warehouse visit, interviews with key personnel. Then what were the key observations which were coming from the due diligence? This brand recall was strong. Even though it was falling profitable wise and all that, the brand recall was strong. It had issues in pricing, receivables, governance, and working capital. All these areas had problem. And there was untapped market potential if operationally restructured. So if they were restructuring, then there is untapped market potential to reach out. Because India is such a huge country. There is space for many. So essentially, this is what is the story of the revival of Magic Blend. Right? So let's look at their business model and core operations. So they had a facility from where they used to manufacture and send goods to carrying forwarding agents who then sold it to supermarkets, the modern trade chains, very little redistribution stockists through whom it went to Kirana stores and then to the customer ultimately. Then to the rural distributor from whom it went to retail stockists, and from the retail stockists to the small shops in the rural areas. So this is how it was being distributed. And they had a robust distribution chain which was there, which they had built over a period, right? The core model was a traditional business to consumer setup, right? With manufacturing, spice mixes, instant batters, fryums, pickles, and ready to cook blends. They had a semi-automated plant in Tamil Nadu, which worked on single shift, 65% peak utilization during festivals. So it was not throughout at very high this thing. Even during peak utilization, it was 65%. So the sales and distribution was operating through a distributor-led network across the south states, because it was the factory was in Tamil Nadu. It was basically going to the south states. India is such a vast country, it is difficult to make it pan-India unless you have a big scale, huge scale you need. Products sold via general trade, Kirana stores, and regional modern retail, right? So it was not sold everywhere, only the regional modern retail it was being sold. Secondary sales was also driven by van sales model and ground sales executives. So especially taking it in van and selling to smaller shops across rural area, etc., was one major method by which it was selling. Raw materials were largely sourced from local mandis. Packing materials were from approved vendors on credit terms. This is how their goods inputs were acquired. The operational gaps which were noticed were that there was no central warehouse. So obviously it had inefficient inventory turnover. There was manual dispatch logs. No digital route optimizations were being planned, right? Today there is so much of digitalization which is possible and so much of planning which is possible for distribution. So all that was not there. It was all manually managed. So when you manually manage, obviously there are inefficiencies in the route optimization which you can do. Then it had very limited e-commerce and lack of premium SKUs. So it had only lower line SKUs largely, very few premium SKUs. And it was not there in e-commerce much. So B2B expansion, growing institutional B2B, white label sales to flight kitchens, caterers, regional wholesalers was happening, right? Because they were losing and losing market. So they were trying to keep production by selling it to white labeling, where the margins are much lower, obviously. Despite having a strong regional presence for select SKUs, for example, like sambar powder, operational inefficiencies and limited digital backbone constrain scalability. So they were not able to scale also because they had operational inefficiencies and lack of digitalization. So in terms of the governance structure, it was run by the promoters group. Promoters group is made up of Karthik, who owned 51%. He was the founder, key decision maker, and he was the signatory for bank or vendors, everything. He was the person who was handling it. Rajesh, who owned 29%, who's a cousin of Karthik, he was overseeing procurement and factory operations. Then Karthik's sister owned the balance 20%. She was just a passive shareholder. So this is the kind of ownership structure and governance. Closely held private limited company with no external or institutional investors, right? There was no professionalized board or independent directors. All strategic and financial decisions were taken by Karthik, who was the founder promoter and owned 51%. So literally, it was a one-man show. So the governance gap was there was no succession plan or formal advisory structure which was in place. There was limited board documentation of resolutions and minutes. It lacked compliance hygiene required for external investor onboarding. So now when an external investor was looking at it, they like to have all the documentation, approvals, etc. in place, resolutions in place, etc. All that was not there. The government was remaining promoter driven with minimal formal oversight. So this was the position at that point. So what are the financial red flags and risk areas which were being identified? In terms of cost management, there was rising input costs. They were also pricing below cost in some cases. Then from a pricing strategy, there was stagnant pricing or discounts being given. From a receivables management, there were overdue receivables. It was having significant cash flow impact. From an operational control perspective, there was weak SKU level costing and poor scheme payout controls. There were scheme payouts which had very limited controls. So overall, there was a weakened operating position. So the financial red flags and risk areas continued. Consistent operating losses, 3-year negative EBITDA margin. Now in a food business, doing negative EBITDA margin shows that company is in deep trouble. The reason was it was unable to pass rising input costs to B2B buyers. As I was explaining, the share of revenue to B2B buyers have been growing over the years, because whenever you are losing market share in the traditional customer markets, you are trying to make up by doing some bulk sales. Those bulk sales to B2B obviously were at lower and lower pressurized prices always, right? So the margins led to negative margins. There was also significant receivable stress. Nearly 1.5 crores was overdue beyond 90 days, which was mainly to modern trade and institutional clients, because institutional clients were growing in numbers also. There were also delayed payments. There were poor collections, which also led to delayed vendor payments. On the payable side, there was 2 crore plus pending. In fact, some vendors have stopped supplying, saying that you clear our dues first, then we will start supplying to you. So that is the kind of scenario it was going under. There was also margin compression happening, below cost pricing on core SKUs, because you are trying to retain or get business, especially B2B business, where there is a cutthroat competition and there is a pricing pressure always. Then there were significant discounts and stagnant pricing policy, leading to profitability becoming negative. As mentioned earlier, there was no SKU level costing system, and they had weak scheme payout tracking. Overall, all this led to working capital crunch, vendor dissatisfaction because you are not paying them in time, unsustainable pricing practices. So, core financial risk requiring urgent action. So, this is what the investor found when he did a DD, right? And then looking at the operational bottlenecks, when they went for an on-site visit and review of what was happening, etc. So there were challenges that significantly impacted efficiency, cost control, and scalability. The plant was working only to 40 to 45% capacity utilization. As you mentioned, even during the peak, it reached only 65%. So on an average, it was only working 40 to 45%, right? So this underutilization was largely due to demand volatility, lack of consistent orders, and supply side disruptions. Another major concern was that the age and condition of the machinery. Many of the packaging and processing units were 6 to 8 years old and lacked modern automation. So they were not modern, they were old time equipments. And there were frequent breakdowns. So this is the scenario which came from the operational side, looking at the entity. Then continuing with the supply chain side, right? The company lacked a robust vendor scheduling system, often leading to raw material stockouts or overstocking. Procurements were all ad hoc. See, as I told you, Mr. Karthik, the one man, ran the show. So he used to take decisions. So obviously, when he has so many pressures on him, sometimes he takes decision in time, sometimes it gets delayed, sometimes he takes a decision thinking that he should quickly act, etc. So a lot of ad hocism. There was no minimum benchmarking of prices or vendor consolidation. So this was also impacting the cost of procurement. Then storage and final mile logistics are partially outsourced with inadequate control on dispatch tracking. So because they did not have digitalized systems, right? They were having inefficiency across. So sales and distribution also had challenges. Retail expansion focus, right? There was also channel strategy which was not there. Then minimal retail penetration. very little retail penetration was happening, and there was over-reliance on institutional sales. So it was a complete mix-up of the scenario. "65% of revenue was coming from B2B, right? Which was one of the reasons why they were making larger losses. 65% coming from B2B. Retail side weakness, they had low penetration beyond tier 2 towns, less than 1,000 general trade outlets, right? So they had only around 1,000 final points of sales, which was happening, and very minimal modern trade presence. There was no clear distributor-led expansion roadmap. So there was no plan to expand. So for you to be able to increase your production, you need to have orders, you need to have sales happening, right? So that was not well done. There was also, like mentioned earlier, receivable stress. There are large institutional accounts which are all over 90 days outstanding, right? Like it was mentioned on the distribution also, it is all poor logistics management. There is no digitalization, everything manual, no tracking, centralized data is not even available, right? And because of this regional tracking not being there, there could be revenue leakage or missed growth opportunities, which are not even aware. So here they thought, what are the actions required? There is a need for channel rebalancing, credit control, retail network expansion, and route to market strategy. So these are all various things which were thought of to address for the future growth. As discussed earlier, cost structure and pricing also had issues. There was lack of procurement planning because one gentleman was doing all the decisions and it was on an ad hoc basis because he's handling too many things. There was also input cost volatility. There was decentralized pricing decisions. So sometimes when something is required urgently, they do go ahead and do something. Discount heavy approach, right? So at every point, when there is a problem with the customer or when there is a pressure from customer, give them a discount or agree for a pricing decision without having a holistic view. So what kind of input cost volatility was there? There were no forward contracts or structured procurement planning, right? Raw materials and packaging prices fluctuate sharply, periodically, right? Because these are largely food products. So obviously there will be. So you need to have a better strategy and longer term plans for that. Margin pressure was mainly because of institutional channels, right, which were expecting heavy discount. Then contributions margins were less than 15% on key SKUs, whereas normal industry standard is somewhere between 25 to 30% on key SKUs. They make 25 to 30% margin, whereas here it was all less than 15% margin. Retail pricing was stagnant despite rising input costs. So as I was mentioning, in pricing, there was absolutely no discipline. Sales teams offered ad hoc discounts. There was no oversight. No centralized pricing policy. So obviously, margins were being lost. So for the areas of cost structure and pricing, it was decided that there is a need to have centralized pricing system. There should be procurement discipline because you need to control cost, not only price, but also cost. Then invoice level controls to protect profitability. So every invoice, are we making money, is something which they needed to look at. The other dimension is the compliance dimension, where They found there were delayed tax filings, there were inconsistent employee dues, right? Basically, they were not paying in time. Then there were operational discrepancies like labeling discrepancies, lack of SOPs for the manufacturing process, which again have legal implications. Weights and Measures Acts have certain specific labeling requirements. There were legal issues with regard to packaging disputes, regarding to employee matters. Then from an organizational structure, it was found there is no in-house legal team and absence of a compliance calendar. They didn't even have a compliance calendar. So obviously nobody was even tracking what is due and what's to be done. So again, going into details, delays in tax filings, PF ESI contributions, TDS deducted but not remitted on time, which can have serious penalty consequences. Regulatory issues like FSA compliance generally met, but labeling errors found, especially on institutional cartons. Risk of regulatory notices can happen in such cases. Legal exposures were there. There were 4 pending cases, 2 related to packaging disputes, 2 related to wrongful termination claims. Total exposure was less than 25 lakhs, but it could have potential impact on your reputation of the company if the cases are decided against you. So that is something which needs to be considered. From a governance perspective, what is found is you don't have a legal team, you don't have SOPs, no standard formats, and there is no compliance calendar. So overall, on the compliance and legal matter, the observations led to the recommendation for implementing a legal tracker, statutory calendar, and also an internal compliance audit to reduce regulatory risk or mitigate regulatory risk, right? Then working capital and cash flow constraints. So much of stress. Obviously, there is no money, right? Especially working capital. So vendor payments, we saw 2 crores is outstanding. On the receivable, 1.5 crores has not been collected. So how do you manage this? So the problems were that there were unresolved claims in receivables, there were delayed payments, and there were slow moving SKUs, there were overstocking of inventory. On the payable side, vendor payment terms were not being met, creditors days are not being met, right? Or probably not even being negotiated well. There were ad hoc loans taken to meet these liabilities. So obviously there will be significant interest burden. It's not a planned, well thought out working capital limit, but ad hoc loans. Obviously the interest rates will be high. So there was a significant pressure on that. Now, if you look at it, average collection period was 92 days, whereas industry norm is 45 to 60 days, more 45, less of 60, right? Institutional clients and distributors were delaying payments. There were also outstanding claims and expired schemes. So whenever you go and discuss with them about non-payment, they will say some claim has not been settled, etc. So for that 5,000 rupees, some 5 lakhs will be outstanding. So you have to have proper systems to address everything. There were issues there. Inventory holding similarly 78 days. So it was a mismatch in demand planning. There were a lot of slow moving SKUs, right? Overstocking of packaging material and short shelf life goods. Obviously, it also loses its usability, so costs go up. So expiry stocks means costs go up. Creditors were over 100 days. Vendors were perennially demanding payments. And some of them said, now onwards, you make payment before we supply. So this was the situation. And the liquidity was being addressed by reliance on ad hoc working capital loans and short-term borrowings, which eat up again interest. Whatever you try and earn, it goes up for interest also. So coming from all this, the need felt was that there was an urgent need for receivables recovery, inventory control, and vendor renegotiation to bring in good liquidity position. So the overall turnaround strategy, which was planned from all this, was to look at cost optimization, reducing expenses across operations, pricing corrections, adjusting pricing strategies for profitability, then operational restructuring, streamlining operations for efficiency from a governance perspective, from a cash flow working capital management perspective, from a equipment utilization, etc. perspective, everything, complete comprehensive operational restructuring, right? So all this was looked at as the focus and plan. So for the first one, cost optimization, they took up vendor renegotiation and bulk procurement arrangements. So you get into this thing saying, okay, I'm going to buy regularly from you this particular product, and let's get into some proper pricing policies between us and give us some better benefits. Then SKU rationalization. By having too many SKUs and slow moving SKUs and all that, a lot of material was being wasted. So by rationalizing the SKUs, they found they could save 8 to 10% material costs. So what is SKU rationalization? For example, if I have, let's say, the same product being sold in a 50 gram, 100 gram, 25 gram, 10 gram, and half kilo package, then what's happening is I need to have so many different packing material. Each of these require a different packing material, which means again I have to carry more inventory, and sometimes these costs are higher because the smaller the packing per pack, the cost of packing will be higher. So you have to balance. If the small packs are not your significant sales area and it's not giving you the right pricing, you rationalize the SKUs so that you cut down the costs, you improve the cost profitability there. So these are things which they had looked at. Then they also brought in centralized control on schemes and proportional overhead. So all the schemes were centrally controlled. Earlier, they had complete chaos on schemes. Oh, they brought a centralized control. Everything was centralized. All schemes were handled centrally, and all promotional overheads were also handled centrally. Then coming to pricing corrections, they exited deep discounts in B2B institutional channels. When you give very deep discount, it's just not worth doing business. It's better probably not to do business. So they started looking at that to ensure that they exit such contracts. Then adopt value-based pricing in strong regional markets. So this is like the surge pricing we were discussing in the earlier thing. There are places where you can bill better, so bill better. So because they had been always under this pressure of price, they had stagnant pricing. Now, in the regional markets where you are selling well and your competition is still not caught up with you and you have this thing, you could increase the prices. Though in B2B, you are not able to do it. In B2C, you could increase the prices so that you can balance out your costs. Then discontinue low margin contracts. So essentially, wherever they were not making money, get rid of it. So that is better than doing for this thing. Maybe we can look at some other option, sell. Operational restructuring, they looked at phased plant upgrades. So like we discussed, it was not modern, etc. So they planned phased upgrades. Also to monetize idle assets. We saw that they were doing only 40-45% capacity utilization. So either sell some machinery or lease to third-party processors so that you get some other revenue. You are going to take time to build your brand and your sales. Okay, fine, but I have capacity. I can produce something. Can I produce for somebody else in the meantime? So become a third party processor. So get some service revenue, which will be an added benefit, which will bring in costs down again by better utilization of your machinery, etc. So this is what was looked at there. And in terms of channel, the idea was to focus on high yield retail and e-commerce and prune underperforming rural distributors. So wherever high yield was happening in retail, focus more on that. Build some e-commerce possibilities because the brand had a good recall. So there could be some possibilities there. Simultaneously, whichever rural distributor was not performing, slowly cut them down because not all areas perform as you expect. So it is better to sell in some other place where you can do better. Overall, the target outcome was they had a 6 to 8% EBITDA plus from negative 2 to 3%. They shifted to 6 to 8% EBITDA, margin improvement and cash flow revival within about 12 to 18 months. This was the overall plan result which was made out. And this is actually a factual case of a company turnaround, right? With all these problems which were talked about and all the issues which were there, only the name, the items, etc., could be different, but it's largely the actual case which has been turned around like this. So, in this background, we are going to look at some specific questions. Again, we can discuss now so that you can also give me your inputs as to what you think on each of these, right? So, let's look at the background for the first question. These are going to be descriptive questions. So, first question is Magic Blend is facing a working capital crunch. We discussed that, right? Due to two key issues. 1.4 crore in receivable is overdue beyond 90 days from B2B clients. And there is excess inventory holding of 78 days. The company lacks a credit control team and poor demand forecasting has led to overstocking of raw material and slow moving SKUs. The turnaround plan proposes tighter credit discipline, pruning risky accounts, and SKU rationalization. Demand-linked procurement and liquidation of obsolete stock are expected to bring inventory down to 50 to 55 days and unlocking 1.2 crore in working capital. So this was background, right? So in this context, please let me know what do you think, how Magic Blend's receivable and management problem had exacerbated its working capital crisis and what specific corrective actions are proposed in the turnaround plan. Right? Your thoughts, please. Anybody, any thoughts? Okay, so let's look at the second one also. Magic Blend's inventory holding of 78 days we saw is very high. It's unsustainable. And how does the turnaround strategy address this? These are the two questions to look at. Okay, somebody has put overdue receivables and long inventory holding. Yes. Yeah, so let's look at the individual specific items. So if you see this, 1.4 crore overdue is beyond 90 days. There is no dedicated credit control team. there is irregular follow-ups. Turnaround plan emphasizes tighter credit control and channel restructuring. So what are the actions proposed? Strict credit policies, enforce 60-day credit caps for institutional buyers, and block further supplies to chronic defaulters. Right? So this should be a policy. Collections team, hire a dedicated team to reconcile disputes. So one of the issues why there were delays in collection, because every time you go to them, they say that there is some small dispute because of which everything is hanging. So you have a dedicated team to resolve disputes and recover overdue amounts. Target is to reduce the outstanding days, right? Outstanding days. Yeah, somebody else has also put full power follow-up. Then channel rebalancing. The third idea is to shift focus from high risk B2B. We saw 65% of my revenues coming from B2B to retail or e-commerce where the credit risk is lower. With all this, you expect to release about 1 crore of rupees trapped in cash, right? And also reduce reliance on short-term borrowings to this extent. So this is what was achieved by the company by implementing these things. They actually achieved about 1 crore of rupees savings in cash position. Yeah. So that is the first one which we were looking at. The second part of it is with regard to the material which were lying. So first one we saw was overstocking of raw materials, which are basically local mandi sourcing and slow moving SKUs. Rationalization of underperforming SKUs was proposed in the plan. So what were the actions actually proposed? They said, first of all, discontinue the lowest 15 to 20% low margin SKUs, right? So use a ABC analysis and determine the low margin items. 15 to 20% of the items stop. So then your general margins will improve. Then bring in demand planning by having just-in-time procurement for pulses and spices, because anyway it was local mandis procurement, right? So you can reduce raw material holding from 30 to 15 days. Then take specific steps. Okay, this will be for future. What about what is already built up? Take specific steps to discount obsolete stock via flash sales or bundling. So how do you do it? You do a sale, 1 week special pricing sale, or you say if you buy X, you will get Y at a lower price. So like this, you bundle and sell. So with this, you get rid of the material and convert it into cash. Otherwise, it is just sitting in paper as some value. It's not giving you cash, right? You have to turn around. So the target reduction to 50 to 55 days of inventory, which would free up about 1.2 crores of working capital. This is what was achieved in the particular case. Then the second scenario we are going to look at in the same case study is the cost structure is burdened by ad hoc raw material sourcing and discount driven pricing. Spices, oil, and packaging are procured from local vendors without benchmarking or forward contracts, leading to price volatility. Simultaneously, institutional sales are priced below cost, with margins dropping under 15% due to unchecked discounts and lack of finance oversight. So we saw that everybody was giving discount at the sales without being any oversight from the finance department. The turnaround plan recommends centralized procurement, vendor consideration, and a CFO-led pricing control. So with minimum margin thresholds and premium SKU launch, Magic Plane aims to cut COGS by 8 to 10% and improve EBITDA margins by 5 to 7%. So from the negative to positive. So here the questions are where again you can share your thoughts. How has Magic Blend ad hoc procurement strategy contributed to cost volatility and what changes are recommended? The second question is, how did Magic Blend's pricing strategy erode margins and what corrective measures are planned? Please pass your thoughts. Okay, I see not much of thought there, but at least let me take through the actions which were taken. And yes, somebody is putting something there. High inventory levels blocks working capital. For pricing, discontinue low margin. Okay. Okay, these are some good thoughts. So let's look at what were all looked at. Deep discounts, right? Should also be looked at, yes. So the first one is to look at total cost of ownership and vendor consolidation, right? So what was the thing we are seeing from the case study? Raw materials are sourced locally without price benchmarking. Turnaround plan highlights bulk procurement and vendor negotiation, renegotiation, right? So what were the actions which were taken? A centralized procurement was put in place, right, to aggregate purchase of high cost items to leverage volume discounts. So somebody was given specific authority and responsibility to do it, right? So they could get volume discounts, bulk procurement, and simultaneous vendor renegotiation. The second item was to get into forward contracts, lock prices for 6 to 12 months with key suppliers so that you are not hit by inflation. Of course, market prices can go down also, right? But by forward contracts, you have some price stability which you can get. So you can, based on that, fix your output prices, and it's not easy to change your output price every week. So one of the key things required in a manufacturing entity like this is to have some input price stability. Next is vendor rationalization. Reduce 30% of redundant suppliers to streamline costs. So you aggregate, you go to few people, you get the right things. In the process, get rid of. See, otherwise you are dealing with so many people. You have to then each one would have its own quality, price, everything. So it becomes difficult. So this contributed a huge contribution of about 8 to 10% on COGS. There were significant savings which came through by doing these three actions. The second part of the question was about the pricing. So here, what is the framework we use? It's a contribution margin analysis and value-based pricing, right? So wherever there were discount-heavy institutional pricing, we saw that their contributions was much less than 15%, whereas industry standards are close to 30%, double. Sales teams were offering discretionary discount without any financial department's oversight. So what were the actions which were taken? They made margin thresholds. They mandated a minimum 20% contribution margin for B2B contracts. And they said exit all other loss-making deals. Anything below 20%, you cannot take a decision. There was a pricing committee made to centralize pricing decisions with CFO oversight to ensure there was no leakage happening. So that anybody and everybody cannot keep giving discounts and adjustments. Also looked at premium SKUs to be introduced so that there can be high margin variants. Like for example, instead of spice blends, organic spice blends, which can go towards retail and e-commerce, not so much to B2B, but retail and some e-commerce, where you can get, though the volumes are less, you can get good margins, and that margin could contribute towards your overall profitability. And you had the capacity, right? So this was something which was done, and this led to EBITDA margin improvement. The third dimension is about the governance. We saw that it is one-man show. Mr. Karthik decided everything, right? Mr. Karthik decided everything, and this concentration led to unchecked decisions and weak oversight. See, sometimes it may not even be necessarily a intentional wrong decision, but it is even unintentional because he has limitations. He has what he knows only he can do. He has pressures on him. He has too many responsibilities put on him. So obviously it makes for wrong decisions. So which is for an incoming investor, these are very big risks. The company has also had cases of PF TDS delays and FSSAI non-compliance issues were found. The turnaround plan proposes board restructuring with independent directors, financial role separation, a compliance officer, and also ERP alerts and periodic audits for regulatory risk mitigations so that regulatory governance issues are properly addressed. So have a compliance officer, have financial role separated, have some independent directors to guide, right? So in the context of this, what in your view are the risks of Magic Plains promoter dominated governance structure, and how is it now they are planning to address it? And similarly, the statutory delays and labeling non-compliance leads to what kind of risks and what are the actions which are proposed or which can be taken? Any thoughts on this? Any specific thoughts on this from students? Okay, so let's take it to the next thing. Yeah, I think somebody has put. Decentralization of roles, centralized decision making. So actually, there are some two contradictory thoughts which are there. Maybe it's meant as separating the roles, probably. Right? Okay, so let's look at the way it was looked at. The framework was SEBI's corporate governance principles and independent directors. So first of all, there is no professional board Karthik controls all financial decision we saw, right? So this is also being identified in the red flags as governance gaps. So what were the actions proposed? First, to restructure the board, appoint two independent directors, right? Either some finance expert or some operational expert from this industry to oversee the turnaround. So by bringing in two independent directors, you are bringing in some calm mind to think and contribute. The second is financial delegation, the separation of roles, not decentralization, but separation of roles, procurement versus payment to prevent conflicts. So idea is to bring in the separation of roles to see that you are taking the right maker checker kind of a scenario, right? So that there is no ad hocism. There is some third person who is actually looking at and oversight is there from the finance for operational action. Generally, operational action will have to have a financial oversight to ensure that it is in sync and it ultimately does not make uh, improper sense for from a financial perspective, right? Then implement a MIS reporting, very important. Implement monthly financial reviews with the investor representative being there. So this way, there will be a comprehensive evaluation of business performance, which would automatically bring in the key person risk in terms of ad hoc decision making and improper governance, if any, on that area. The second part of it is to use a COSO ERM framework and a compliance calendar, right? So what was found, there are delays in payment of TDS, PF, ESI. Then there are FSSAI labeling issues which are under this thing. So the turnaround process was talking about periodic audits and a legal tracker. These were the key terms from the turnaround process which was being recommended. So what were the actions which were implemented? They got in a compliance officer whose idea was to follow up on all compliances across not only taxes, labor law, but operational laws like FSAA also. Then there were label audits. So essentially specific audits on packaging and packaging related law requirements to ensure that they take immediate non-compliant packaging to correcting it immediately so that they don't have continuous problems on that. Then do some tech integration for ERP alerts for statutory dues, etc., and have a calendar. So this led to avoiding penalties, which was estimated to be about 25 lakhs of savings by not paying those penalties and legal exposure. Of course, there could have been a reputational damage also, which was saved. Now, with that, we come to the MCQ questions on this, right? And after the MCQ questions, we can have some free discussion on any matters relating to all these topics. The first MCQ is Magic Blend has reported trade receivable of 9.2 crores on a turnover of 24 crores in FY23. What is the average receivable period in days and what does it indicate? It is 10 days, which indicates strong debtor control. It is 90 days within acceptable limits for FMCG. It is 60 days suggesting aggressive collection. It is 140 days, which is a sign of poor receivable control. What, in your view, is the correct position? A, B, C, or D? Any thoughts? Okay, so let's look at, somebody has said, I didn't understand how to calculate this in days. So let's look at the calculation also when we look at it now, so that it is clear. Somebody has said D, somebody has said B, right? So let's look at the answer now and also how it is computed. The answer is 140 days, which is a sign of poor receivable control. Of course, we have been talking about a company which has been in trouble and having receivable issues, right? How it is calculated is 9.2 crores is the outstanding and 24 crores is the sales. When you multiply it by 365 days, you get 140 days approximately, right? So what we do is, in other words, 24 crores is the sales in 365 days, which is about 6.5 lakhs per day. So 9.2 crores, if it is 6.5 lakhs, it's about 141, say 140 days approx, right? That's how you arrive at that 140 days. This is unusually high for a FMCG company and suggests poor credit policy and collection discipline. In fact, 45 to 60 days is a very good period in a company like this, maybe. Not even 90 days. Is that clear? I suppose on this thing. And next one is MCQ 2, which is Magic Blend has two production lines with a combined capacity of 1,800 metric ton per month. However, actual average utilization was 780 metric ton per month in FY23. What is the utilization rate? Whether it is 43% and underutilization risk or 78% on optimal utilization, 56% of moderate utilization, or 90% of excellent utilization. What will it be? Yeah. So someone has said A. One more person A. Yes, it is A. Let's look at how it is. It is 43% underutilization here. Utilization is 780 average as against capacity of 1,800. So 780 divided by 1,800 into 100 is 43% approx. So what does it mean? It has so much of idle capacity that you could do something. In fact, that's why one of the suggestion was to look at either selling some of the assets or to lease or contract with somebody else for manufacturing for others. MCQ 3, the due diligence report highlights that 74% of Magic Blend's revenues from institutional sales. Actually, inside it was a different number. 74% was from institutional sales, most of which are on 90 to 120 day credit terms. What is the biggest risk associated with this? Is it lower marketing costs, higher profit margins, inventory obsolescence, cash flow mismatch due to delayed collections? So someone has said D. One more D. Yes, it indeed is D. Cash flow mismatch due to delayed collections. Heavy reliance on long credit institutional sales affects cash flows. It delays. Because of that, what happens if you don't get money, you can't pay your vendors. So vendor payments also get delayed. And it either creates funding gaps for operational expenses or you have to borrow at high cost. Again, eating into your profit. The next fourth question is Magic Blend had 63 lakhs in unpaid GST and 17 lakhs in PF ESI dues as of March 23. Which of the following risk is most relevant? Consumer dissatisfaction, audit qualification and regulatory penalty, high salary costs, or product recall? Okay, B, yes, B, yes. So under CARO, if there are unpaid taxes or overdues, it is supposed to be reported. So audit qualification is one critical risk. Regulatory penalty, any delays will automatically have interest and there could be penalties also. So that is the regulatory issues which can come. So audit qualification and regulatory penalty is the risk which is there. The fifth question, we are coming to the last question. Magic Print's input costs rose by 18%, but its average selling price rose only by 7%. What is the most likely impact? Input costs rose by 18%, selling price rose only by 7%. What is the most likely impact? Improved gross margin, lower working capital, margin erosion and profitability decline, increase in EBITDA. C, yes. So it is all C all the way. All right. So there is a margin erosion. My input cost has gone up by 18%. My sales has gone up only by 7%. Obviously, there is going to be margin which will drop. Because margin is dropped, profitability will also go down. Right? So with that, we come to the end of this presentation on this case study. See, this is a case where, as I was mentioning, there was an actual turnaround which was made on a similar company on by and large the same kind of numbers and same kind of issues. By and large, of course, some things have been changed so that it doesn't have the actuals. So now we have some time, we can discuss on any open questions which you may have. Anyone having a question can put across and we can discuss that.
Thank you, sir, for highlighting the importance of understanding and approaching IBS case studies effectively. We hope all our students will take this opportunity to deep dive into the subject and make the most of the insights shared. Wishing everyone a fruitful learning experience. Students, you are free to ask any query. Now I start with the special examination tips. First of all, use the initial reading time wisely. Start by doing through the requirement parts of the case studies first. Identify the ones you are most comfortable with. This helps in better time management and boost your confidence early on. Don't ignore MCQ section. Since MCQ carries 40% weightage, keep an eye on them during your initial reading. A wrong selection in the beginning can waste your time and affect your ability to attempt the full paper properly. While reading a case study, jot down key points. Note, please jot down key points based on questions requirement. For example, if a question is related to Ind AS 41, mark or note down important words, figures, or paragraphs that seems relevant. This early step is extremely useful for drafting your answer. I call this sketch making. You may need to refer study material during the exam. Some students create their own index to navigate quickly. That's fine, but the best index is your mind. If your concepts are clear, not if your concepts are clear, you can scroll and find what you need efficiently. If not, you may end up with wasting your time. And even after finding the correct content, you may not be able to apply properly. For example, in past exam there was a question on ECB norms. Okay, it is connected with FEMA. Okay, students who had studied the concept could refer quickly and apply it. Others spent too much time looking and still could not apply it well, affecting the rest of the paper. This exam is not about hunting for answers in the module. It is about how well you understand. It is about how well you understand and apply concepts. If your conceptual clarity is strong, I am sure you will do 100% in your exams. Start answering on the left side pages. Okay, this gives you the right side. This give you right side for any rough work or calculation if required. Always attempt all required questions. Make sure you cover all parts in the paper. Even brief answer can fetch good marks. Now, there is a query. I have not studied the self-paced online modules in detail. What should I do now? Okay, I sincerely request all of you to take them seriously. Set A covers corporate and economic laws. One thing is certain, that is the Companies Act. Companies Act will apply to almost all companies discussed in the case studies. Whether it is a multiple choice question or descriptive question, you are very likely to encounter questions from Companies Act. In today's context, where corporate failures are increasingly reported, corporate governance become highly relevant. Questions based on this topic are generally simple and can be connected easily with any scenario from any area. Therefore, corporate governance is very important. If the company in if the company in your case study is listed, then again SEBI LODR, SEBI regulations are very important. Similarly, if the company has a foreign operation or your company wants to invest in foreign, then FEMA, you may expect question from FEMA. Overall, you can expect around 15-20 marks from this area. Therefore, don't ignore set A. Now, set B. Set B is another important area because it covers various strategic models like Porter's 5 forces, McKinsey 7S, value chain. There are so many models through which strategic decision making is connected. Okay, it is advisable to practice how to apply these models. Okay, rather than just memorizing the same. Okay, therefore I advise you to create a mind map. Creating a mind map of key strategic models and their applications is very useful in your exam. Therefore, solid conceptual understanding for both sets is necessary. There is one more query. Please tell what are the books we need to take to examination hall during IBS examination. Students, Feel free to refer any study material you are comfortable with. You may take any material, but I advise to carry the material that forms the foundation of your preparation. It is very useful. In addition, any mind maps or charts you have created to simplify concepts like Companies Act, SEBI, LODR, FEMA, Ind AS, corporate governance, any strategic models you can carry. In fact, creating your own mind maps is highly recommended. What I am saying, create your own mind maps, because the best mind map is the only one which is prepared by you only. When you make it yourself, you remember the flow, you remember the flow in a better manner, know exactly where to find what during the exam. It helps you to link concepts quickly and apply them under pressure. Remember, the focus of this exam is on application and analysis. Okay, not just a simple memorization or simple recalling anything. So take only those material that helps you in application of your knowledge. There is one more query. Uh, what should be my focus during last one day before the exam? In last one day before the exam, focus on revising key concepts from your strong subjects. Okay, please revise concepts from your strong area like FR, audit, taxation. Give special attention to, I am repeating, give special attention to strategic concepts, corporate governance, SEBI, LODR, FEMA, Ind AS, Forex, or taxation concepts. Go through 2-3 past case scenarios and observe how answers are structured. It is very important how to write the answer, how questions are approached, how models are applied, how conclusions are drawn. It is very important. Okay, on the last final half day, revise your notes and mind maps. Don't overload yourself with new content or new concepts. Stay comfortable and relaxed. Okay, and final tip is, this exam is not how much you memorize, it is about how well you apply your knowledge. There is one more query. There is one more query. Hi, respected sir, please explain how to proceed with IBS paper preparation. Okay, to prepare this paper effectively, start by reviewing case studies from the portal. First of all, go to BOS Knowledge portal, then start reviewing case study. Review case study digest, mock test paper, revision test papers, and we have given several good case studies in students journal. These are real life case studies. Okay, then focus on mastering key concepts from FR, AFM, law, audit, SCM, while also learning how to apply provisions in a practical scenario. See how we have applied relevant laws in practical scenarios. Build a strong integration of understanding. Okay. Again, this paper is nothing but it is application of your conceptual knowledge only. Regular practice of case study is very important. Therefore, do practice and practice. Stay updated with recent amendments. Okay, and develop to provide accurate and relevant solutions. Students, you may ask if you have any query, and you can speak. Students, unmute yourself. Prashant, Pranav, Mansi, Smriti, Vidya, please ask.
Yeah, thank you, sir, for your valuable guidance.
Thank you.
As you say, this amendments part we need to be very thorough with,
Yes,
and I think the each question we can allocate the time for each question. We need to calculate and see to it that we don't take more time beyond that.
yes.
Your suggestions are valuable, sir. Thank you, sir.
Welcome, welcome. Uh, for the September examination, amendments notified up to Feb 2025 will be applicable. Students, please note that for September examination, amendments notified up to Feb 2025 will be applicable. However, detailed guidelines will be released only after May 2025 examination to ensure clarity and avoid any confusion.
Okay, sir.
Okay. Prashant. There is one more query. Normally, students ask, Sir, I am giving group 2 and clear group 1 in previous exam. What approach should I follow in IBS paper to score well? It is a common query I am taking again because students are asking so many times this query. Okay, this is my personal view. Even if your primary goal is on group 2, you may select one or two papers from group 1 and prepare them thoroughly, in addition to your direct tax and indirect tax papers. At the same time, build a basic conceptual understanding of remaining subjects. Why it is important? Because if you are aware about key concepts and their application, then you can easily correlate and apply in your examinations. Okay, this approach not only boosts your performance in IBS but also it will help after you qualify in CA examinations. Okay, students, any other query? Yes, Samriti, post qualification it will surely help you. Suppose you if you are preparing for group 2. Okay, simultaneously you do practice of FR. It will be also help you in long run when you qualify your C exam. Similarly, you may opt any other subject and you may try to gain control on that. It will be very, very useful. Let me check. Now, let us wind up this session. As we come to end of today's session, I would like to take a moment to express our heartfelt thanks to our speaker TV Bala Subramanian sir for sharing his time, wisdom and rich experience with us. Sir, your use of real world examples, particularly on disruption, gave us particular insight into how strategy plays out in business scenarios. Yes, student. Okay. The way you explained how companies adapt to change and make strategic decisions has helped us better understand the mindset required to tackle case studies. It aligned well with the objective of IBS paper, which encouraged us to approach problems like decision makers rather than exam takers. To all the students here, thank you for your participation. Your thoughtful questions and active engagement made the session vibrant and meaningful. We hope this session gives you more confidence as you approach case studies in the future. And remember, this is just the beginning. Keep exploring, stay interested, and always aim to think beyond. Before we go, here's a fun teaser. Okay, for our next session on 9th May, we will be diving into a new case study, this time on a globally renowned company in the fast fashion industry. Its founder is currently ranked at 14th richest person in the world and a net worth of over $100 billion. Any guess who this could be? Can you guess, students? Can you guess the company? This company is globally renowned company in fast fashion industry, and its founder is 14th richest person in the world and having net worth over $100 billion. Can you guess? Drop your answer in the chat box. Let us see. Then you have to wait for a 9th. Until then, take care, stay connected, and keep learning. All the best, and thank you once again.
Thank you all. Thank you.
Thank you, thank you. Vidya, you are right. It's Zara.
Thank you, sir. It was my daughter's answer. Sorry.
Okay.